Index funds are often touted as the holy grail of investing. Low fees and simplicity are their biggest selling points. But what if this perceived safety is just an illusion? What if there's a dark side to index funds that no one is talking about? We need to peel back the layers and examine the potential risks lurking beneath the surface. Investors are flocking to index funds, enticed by the promise of easy returns, but this herd mentality can be dangerous. Are we overlooking the inherent vulnerabilities of these seemingly foolproof investments? The truth is, index funds are not without their flaws. This essay will delve into the often ignored risks associated with these popular investment vehicles. We'll explore how the very structure of index funds can expose investors to unexpected dangers. Get ready to challenge conventional wisdom. It's time to uncover the truth about index funds. Most index funds are market cap weighted. This means that companies with larger market capitalizations hold a greater share of the index. Sounds logical on the surface, right? Bigger companies, bigger profits, bigger returns. But here's the catch. This approach creates a concentration risk. A handful of mega-cap companies dominate the index. Their performance heavily influences the entire index's returns. Think of it like a seesaw. On one side, you have a few giant companies like Apple, Microsoft, and Amazon. On the other side, you have a vast number of smaller companies. The weight of the giants significantly tilts the seesaw, making the index highly dependent on their performance. This concentration can be problematic. If one of these mega-cap stocks stumbles, the entire index feels the impact. This lack of diversification exposes investors to greater volatility and potential losses. The dominance of tech giants in today's market is undeniable. Apple, Microsoft, Amazon, Google, and Facebook have become household names. They are the titans of the digital age, but this dominance has seeped into the very core of index funds, creating an alarming concentration. The S&P 500, a popular benchmark index, is a prime example. These 5 tech giants now account for a disproportionately large portion of the index. This concentration amplifies the risks associated with market cap weighting. Let's put this into perspective. Imagine investing in a basket of 500 apples. But instead of having a variety of apples, 20% of the basket is filled with just one type, gala apples. Now imagine a sudden disease that only affects gala apples. Your entire investment is at risk because of the lack of diversification. The same principle applies to index funds with a heavy concentration in tech stocks. Any negative event affecting the tech sector could send shockwaves through the entire index, impacting your investments. Section 4. Riding the tech wave, a bubble in disguise. The tech sector has been on a tear for the past decade, fueled by innovation and a seemingly insatiable appetite for digital products and services. Tech stocks have soared to unprecedented heights. This relentless growth has created a sense of euphoria, with investors pouring money into anything remotely related to technology. But could this euphoria be masking a dangerous reality? Are we witnessing a tech bubble inflated by hype and speculation? History is littered with examples of bubbles that eventually burst, leaving investors with devastating losses. The dot-com bubble of the late 1990s is a stark reminder of the perils of irrational exuberance. Investors, blinded by the promise of the internet, poured money into companies with little to no earnings. When the bubble burst, countless companies vanished overnight and investors lost trillions of dollars. The current tech boom shares some eerie similarities with the dot-com era. Valuations are sky-high, driven by growth expectations rather than fundamental value. Investors are betting on the future, but what if the future doesn't unfold as predicted? The higher the climb, the harder the fall. Section 5. Decoding investor expectations beyond the index fund hype. Investors often gravitate towards index funds, believing they are investing in a diversified basket of companies across various sectors. While this is partially true, the heavy concentration of mega-cap tech stocks skews the reality. Many investors are unaware of the extent to which their index fund returns are tied to the performance of a handful of companies. They assume diversification when, in reality, their investments are heavily exposed to a single sector technology. This disconnect between investor expectations and the actual composition of index funds is a cause for concern. It highlights the need for greater transparency and investor education. Investors need to understand the underlying holdings of their index funds. They need to be aware of the potential risks associated with sector concentration. Blind faith in index funds can be dangerous. Informed investing requires understanding what you own and why you own it. Section 6, Warren Buffett's index fund paradox. Even Warren Buffett, the Oracle of Omaha, has endorsed index funds. He famously wagered that a low-cost S&P 500 index fund would outperform a portfolio of hedge funds over a 10-year period. And he won. Buffett's endorsement has further fueled the popularity of index funds. But here's the paradox. Buffett himself is not a passive investor. He is a value investor who carefully selects individual stocks based on their intrinsic worth. Buffett's endorsement of index funds comes with a caveat. He recommends them for investors who lack the time, knowledge, or inclination to actively manage their portfolios. He recognizes that for the average investor, beating the market is extremely difficult. However, Buffett's investment philosophy is diametrically opposed to the principles of market cap weighting. He seeks undervalued companies regardless of their size. He's not swayed by market trends or the hype surrounding popular stocks. Buffett's endorsement of index funds should not be misconstrued as a blanket recommendation for all investors. It's crucial to understand the context and the limitations of his advice.
Like, share, and subscribe to our channel for more updates.